The United States will once again consider itself a growing nation, one that increases our wealth, expands our territory, builds our cities, raises our expectations, and carries our flag into new and beautiful horizons. The American people have spoken.
Welcome to the week ahead on Nomura Podcasts. It's Friday the 24th of January and I'm Dominic Bunning, head of G10 FX Strategy. We've just heard from President Trump in his inauguration speech, and as we record this, we're only a few days into the new administration's term, but already there's been a lot of action. Over 25 executive orders have been signed, and we'll have David Seif joining us to explain what these might mean for the macroeconomic outlook and what else to watch. Andrzej Szczepaniak will join us to give a European perspective on proceedings and to preview the ECB meeting. And our economist Jing Wang will help us understand what the latest developments mean for China. Well, it's been another volatile week in financial markets following Donald Trump's inauguration as the 47th President of the United States. Markets appeared to breathe a sigh of relief on day one, as there was little real follow-through on the threat of major tariffs and a bigger focus on immigration, energy policy, and even the prospect of sending men to Mars. The dollar initially softened as markets digested the possibility of a slower rollout of trade policy, while US yields have also fallen from their recent highs. Equity markets remain in buoyant mood with the announcement of Stargate's investment in AI, potentially boosting expectations in that space. And so with plenty to get our teeth into this week, let's get stuck in.
I will immediately begin the overhaul of our trade system to protect American workers and families. Instead of taxing our citizens to enrich other countries, we will tariff and tax foreign countries to enrich our citizens.
Well, the US is the obvious place to start, and we've just heard briefly from President Trump's inauguration speech about the proposed overhaul of the trade system. David Seif, our chief economist for developed markets, is with us again this week. Thanks for joining, David, in what I'm sure is an even busier time than usual for you.
How are you, Dom? Great to be here.
Yeah, we're enjoying it just as much on this side of the pond as you are, I'm sure. So, look, we're a few days into Trump 2.0, and maybe markets are feeling a little bit of relief that the tail risk of significant tariffs being imposed on day one hasn't materialized. How are you thinking about trade policy at this point? Has anything materially changed for you?
Well, the bottom line for us is our big picture view is quite unchanged in that we still expect Trump to impose significant tariffs on China, on most countries in the world, in the first year of his presidency, and think that will both lead to an uptick in inflation and limit the extent to which the Fed is able to cut. We continue to expect only a single 25 basis point cut from the Fed this year. Now, of course, it is true that on January 20th, there was a decent risk, it seemed, and we certainly agreed with that Trump might impose tariffs on day one, and he did not do that. I think that the market should not become too complacent based on that, and I don't think it should read that as meaning he won't do so at all. And I think the relatively muted market reaction that we have seen since it became clear Trump was not going to announce tariffs on day one shows that the market sees this more as a delay rather than a cancellation.
Yeah, I think that makes a lot of sense. And the risk will be there to some extent, whether he announces something on the 1st of Feb or a little bit later. There's always going to be that risk hanging over markets for the time being. Outside of trade, has there been anything else over the first few days which has caught your eye or surprised you that might have a meaningful impact in terms of the macro outlook?
Yeah, I think big picture and notwithstanding trade, Trump really hit the ground running. He not only hit the ground running, if you look at sort of the number of executive orders he signed, et cetera, more than he did during his first term, but actually more than really any president in modern times has. And so I think what it shows is that there's much more experience in this administration than there was 8 years ago when Trump took over. And that's not a matter of, what the policy direction will be, but it's much more a matter of they will be more aggressive, quicker, and more able to carry out the agenda this time around than they were 8 years ago. So I think it's very unlikely, for example, that we will get into 18 months or so without Trump having taken significant action on all of his major policy priorities, very much including tariffs. And that really was the case in his first term, where things were rolled out much more slowly in certain areas.
So that's going to keep things nice and volatile, hopefully, for financial markets if there's plenty of bits going on. Okay, well, away from politics, and you did mention the Fed briefly earlier on, but we do have the FOMC meeting next week as well. We're looking for an unchanged Fed funds rate, as is the consensus. That all seems fairly straightforward, I think. But what else do you think can move the needle for the market in either the statement or in Powell's press conference next week?
Yeah, well, we expect the meeting to be fairly uneventful. As you said, we think rates will remain on hold. And this will be the first time the Fed has not cut rates since the July meeting last year. In terms of uneventful, that means that we think that Chair Powell's press conference will be relatively hawkish, as was his December press conference and as have his last couple of public appearances. I think that he'll emphasize that the FOMC can be patient about resuming rate cuts, but I think he'll also decline to comment on any potential policies of the new Trump administration. The FOMC, of course, is updated since it's a new year. It is a modestly more dovish makeup than last year, but nothing that will really move the needle, we think, in terms of actually changing where Fed policy will go this year.
Okay, brilliant, David. And that just remind us, your view is we've got a March cut and then nothing else for the rest of 25, correct?
Yes, that's correct. So compared to market pricing, we're actually a little bit more dovish for March, but more hawkish for the entire year. And that's really predicated on the idea that we think that the inflationary impulse behind tariffs will really come later in the year. And so if the Fed is going to cut, assuming we're right about tariffs, it sort of needs to do so relatively early in the year because it just won't have that opportunity later in the year, we think.
Great. Thanks, David. Always great to have you on the show. Have a great week ahead.
Thank you. Thank you very much, Dom.
No blanket tariffs on Europe. Is that a welcome reprieve?
It's what I expected. And I think it's a very smart approach to the matter of trade.
Moving to Europe, we've just heard from ECB President Lagarde there outlining her lack of surprise that there weren't any tariffs on day one during a CNBC interview. But in the short term, the market might care a bit more about what she has to say about monetary policy at the ECB press conference on Thursday. Andrzej Szczepaniak joins us to talk about that and more. Andrzej, good to have you on.
Thanks, Dominic. Good to be on.
So, as with the Fed, there's a pretty clear consensus for the ECB, albeit that's for a 25 basis point cut rather than unchanged rates. Outside of the actual decision, what else do you think the market is going to be looking at?
Look, as you say, everyone's expecting the ECB to cut rates, and I think most people would not be surprised if the decision was unanimous, actually. Beyond that, we don't expect guidance to change. Don't forget the ECB already materially changed guidance at the December meeting. Now, I think the focus is very much on the Q&A, so the press conference, and what Lagarde gives away, if anything, regarding how it might think about Trump's policies, US tariffs, etc.
Yeah, and on that point, I mean, we've heard from David Seif at the top of the show about the likely impact of policies. Maybe tariffs haven't come quite as quickly as some in the market feared. How do you think Europe, both in terms of the ECB and maybe at a broader fiscal level, how are they going to react to any tariffs?
Look, so the way we're thinking about US tariffs on Europe, it's essentially bad for growth. You have this sort of trade-off between growth and the hit to growth from tariffs, as well as this sort of inflationary impact from retaliatory tariffs. We think growth will dominate. And obviously, if you think about US tariffs on China, we think that spills over onto Europe and is deflationary. So all else equal, it has to make the ECB more dovish. And obviously, that's part of the rationale as to why we think the ECB will cut rates eventually to below neutral. We're forecasting a terminal rate of 175 by September this year with downside risks. But obviously, from that perspective, as you say, there's a lot of uncertainty. But yeah, that's our view.
Great. Thanks, Andrzej. I mean, it's obviously a kind of pretty negative story for Europe for most perspectives. The currency's been weakening, even though we've had a bit of respite. We're starting to see some signs that equity markets have bounced a little bit. Can you give us any sort of positive news at all for the euro area as a whole?
So actually, we do think that surveys are likely bottomed out. So we do expect the PMIs over the course of Q1 to improve. We have seen that there is this sort of post-pandemic residual seasonality, certainly within the services PMIs, and we think that'll actually push those PMIs higher during Q1. Also, don't forget the manufacturing PMIs. Essentially, they've been in the doldrums for such a long time now. There's only so much further they can worsen, and we do expect that will begin to tick up over the course of Q1 as well.
Interesting. That's great, Andre. Appreciate your time. Thanks very much.
Thanks, Dominic.
Now, moving to Asia, we've obviously spoken a lot about the impact of Trump's potential policies, especially trade, on both the US and the rest of the world. And nowhere really is more in focus, I think, than China in particular. We're joined this week by our China economist, Jing Wang, who can hopefully help us navigate what everything means for the China economy. Thanks for joining us, Jing.
Yeah, thanks, Dominic. Good to be here again.
Well, we've had nearly a week of Trump's new administration, Jing. How are things looking from a China perspective? Are we going to see a big policy response? How is China going to deal with the potential for increased tariffs? Can you just give us a quick overview of your latest thinking there?
Yeah, so over the past week, it has been quite interesting. Some people feel encouraged by this phone call between President Xi and President Trump. Some even said this couldn't have been a better start for two countries, for next 4 years. And it seems like the chance for China to face a large tariff from the US in the very near term is not that high. But however, I would say overall, people are still concerned about Trump, his tariffs, and those self-claimed China hawks in his team, right? So that's why we are still seeing those front loadings of exports happening. Just to give you some data, China's exports to the U.S. Jumped almost 16% year on year in December, which is the highest increase since the export boom during the pandemic. And we think the front loading is still ongoing because we still have this threat from the tariffs. But I say, right, those front loading cannot last forever. It may reach a limit at some point, given the capacity limit, for this logistics and the warehouse, right? And Trump administration is still very likely to impose tariffs on China at some point. Because he has already directed his team to conduct a flurry of those investigations on the U.S.-China trade relation, including the Phase 1 trade deal.
Thanks, Jing. And in terms of maybe the potential fiscal policy response, is that something that might come relatively soon after tariffs are announced? Do we need to wait for the MPC in March? Have you got any sense of when we might see a few more announcements potentially on any more fiscal easing in China?
So for those fiscal stimulus measures, especially the numbers, we will still need to wait until the March MPC meeting. But I would say because of this potential relief, no imminent, tariff, from the U.S. side, the chance for us to see the fiscal stimulus numbers to undershoot at the March MPC meeting is on the rise, because Beijing may save some policy options for the future tariff.
Interesting. So very interesting backdrop, really, where you've kind of got this front loading, which is sort of pushing up some of the data in the short term, maybe some optimism that tariffs aren't coming quite as quickly as people might have feared, but still a kind of challenging structural outlook. Just looking to the week ahead, we do have the Lunar New Year holidays starting fairly soon, but we get the PMIs before then. Have you got any sense of whether there's room for another short-term upside surprise here, or do you think this kind of data will just pass fairly quietly?
Yeah, so regarding the PMI, we expect the official manufacturing PMI to stay above 50 so still in the expansionary territory, because we have this policy support from this expanded consumer trading scheme, and plus, as what I mentioned, this potential front loadings of exports may also continue to support the manufacturing sector. But that said, right, so those front loadings of exports and also those consumption of durable goods may not be sustainable, and we just maintain our overall cautious view on China.
Great. Thanks very much, Jing. Really appreciate having on the podcast. Have a great week.
Thank you. Bye-bye.
So that's it for this week. Thank you for joining us at Nomura Research on the Week Ahead, edited and produced by John Dalton. If you enjoyed the content, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud, or your usual podcast provider. We'd love to hear your feedback, so feel free to leave a review, share this episode with your colleagues, friends, family, and anyone else you think might be interested. You can also head to NomuraConnects.com to keep up to date. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.